Now, the other myth is, and man, people have got to get this out of their head because this gets repeated ad nauseum on the media. They say the stock market is not the economy. That is a true statement, except it's totally erroneous. But historically, going back through history, there's a very high correlation between two things. One is economic growth, the other is earnings.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart here at the end of the week. Looking forward to another weekly market recap with my good friend Lance Roberts. Hey, Lance, how are you?
I'm doing fine. Just ready for a long weekend.
Yes, yes. I think a lot of people are, at least those that have been watching the markets recently. So I got a bit of a list here. Let's see here. I think there's a lot of people that are, if anything, I would say are just kind of getting sick and tired of the markets right now. But let me let you drive here.
That's a good thing. I mean, the what we want to see, ultimately is we don't want people wanting to buy stocks. We just want people to give up on the market. That's when we'll find the bear market bottom, right? It's something I'm actually writing in our newsletter for this weekend is that what we need. And, July is normally a little bit seasonally stronger month. Now, seasonality hasn't worked at all this year, right? So, the seasonally strong period of the year didn't work this year. Seasonally strong months didn't work this year. Seasonally weak months were weaker than expected. It's just been that year where nothing's really seemed to work. But what we need here is a bit of a rally that would get Jim Cramer on CNBC to start pounding the table that the bear market bottom is in. And that'll be the opportunity to likely, raise more cash and be a little bit more cautious. We're not through this bear market cycle yet. And another thing we're talking about in this weekend's newsletter is that, earnings estimates on the S&P have not accounted for recession. And I know you've probably gotten your notes squirreled away over there somewhere. The GDP Now report that came out today.
You just mentioned the literally number one and number two on my list here. So keep going.
The GDP report from the Atlanta Fed came out yesterday. They put out an update, which was negative 1% growth for the first quarter. And in one day, they updated it again today on July the 1st for negative 2.1%. And now this, mind you, is down from 0.3% positive growth just a week or so ago when they were making that revision there. So we've gone.
Sorry to interrupt, but that was an upwards revision from 0.0. So it had trended down to 0.0, and this just shows kind of like, what the heck are these guys watching, right? Because it trended down, then whoa, hey, actually it's getting positive again. Whoops, no, now it's down negative 1%. Oh, wait, no, next day now it's down negative 2.1%.
Yeah, but again, so that's a great point. The Atlanta Fed. So as opposed to the Bureau of Economic Analysis and the Federal Reserve, by the way, which looks at trailing data, the GDP Now is tied to real-time inputs into the economy. So, for instance, you've got say 0% growth, right? And then you have a little bit better than expected jobless claims numbers that come out, which contribute to the unemployment side. So that actually increases GDP a bit based on that report. And then the next 2 days, you get terrible PMIs from Dallas, from the Richmond Fed, from the Philly Fed. Chicago PMI was very negative. ISM was negative. Spending was much weaker than expected. So all that, fed that real-time data fed in and pulled that quarterly report down. So that's why you see these bounces, because they're looking at more real-time data versus the Fed, which is, again, we just saw the third estimate this past week of the first quarter GDP. So here we are in June, finally getting the last number for the first quarter GDP, which actually turned out to be even weaker than previously expected. It was 1.6 versus 1.5.
Right. So negative 1.6.
Then negative 1.6, correct. And see, this is a problem for the Fed. And one of the reasons that the Fed is going to make a mistake, they're looking at data that is still in revision mode from 3 months ago. And this is particularly problematic when you get into inflation, where the latest really kind of housing price data is 3 months old. And remember, too, and we talked about here about selling houses and those type of things. So when you start seeing price declines in homes, that isn't that's accounting for people that are selling their houses, et cetera. So for instance, if the house is listed on an MLS website, as an example, let's say Adam's going to sell his rental property that doesn't belong to him. So he puts his property up for sale and he says, okay, this house is worth, $1 million. So that data gets sucked in to the pricing of houses, right? But that doesn't mean that Adam sold the house at $1 million. He may sell that house at 700,000. So by the time that data shows up, so think about, first thing he's going to do is got to sell the house, and then it's got to, go through the whole appraisal process, inspection, go through closing, finally get to closing, and then get reported. That's about 3 months altogether. So all this housing data that we look at relative to the inflation is very dated data. So again, while we're looking at housing inputs, which is 42% of CPI, by the way, it's a very big component. That data is about 3 months lag. So it's going to take a couple more months before we see that housing data start to get priced into current inflation. But we just saw PCE, personal consumption expenditures, turn down this past week. That's what the Fed watches in terms of inflation, by the way. They watch the trimmed mean PCE. That's their inflation gauge. That actually had a fairly decent decline this past week over the first quarter. So again, this is all starting to price in. But the reason the Fed's going to make a mistake is because they're looking at data from the first quarter, and real-time data is suggesting that inflation, economic growth, real wages, real spending are all much weaker than what data looks like, on a trailing basis.
Yeah, and when people say that the Fed tends to make mistakes because they're looking through the rearview mirror, it's exactly what you've just been talking about, right? Yeah. All right. Well, look, you mentioned a couple important things there. One is that GDP expectations are now negative and continue to get more negative now by the day, literally. But that's another good indicator. I guess technically, now that Q2 is done, we are in what's called a technical recession. Mm-hmm. Right? That's back-to-back quarters of negative GDP growth. But those are definitely continued indicators of what we've been talking about, which is that the economy is slowing here, right? And so we've been sort of waving our hands and saying, look, folks, slower economic growth going forward, maybe potential for recession. I think we both think the odds for recession are pretty darn high now at this point in time, but this is just sort of validating data, right? But the other big thing you mentioned that I do want to dig into a bit, which is, we talked about this in a few previous videos, but is it's likely to be the next shoe to drop to drive asset prices even lower, which is the bringing down of forward earnings estimates, right? So we talked about how if you looked at, I don't know what the latest ones are as of today, but as of recently, the average analyst expectation for S&P corporate earnings next year was still up 10%, despite the slowing economy and all these other things, right? So it's like at this point, it feels like a fantasy, or at least if you're on the numbers, it definitely slaps you in the face as such. And so we've been saying, hey, when, in mid-July, when these companies really start, announcing having their Q2 earnings calls, we're very likely going to see the street and analysts getting disappointed as these companies bring down their forward projections. And that's going to force the analysts to have to revise their models, bring down future earnings projections. And mathematically, that would bring down, what they're putting out there as target prices for stocks, right? And we got some validation on that just the other day when Micron announced their recent earnings. And they crushed it from both a quarterly earnings and a revenue standpoint. But their forward projections were so disappointing that the stock just got clobbered. And I sort of looked at that as validation of what we're talking about here. It's like, I think this is a preview of what's to come. What do you think?
Well, no, you're absolutely right. I want to. We're going to solve a couple of myths here while we're talking about this. But it's not just Micron that has been really guiding down on forward estimates. If you take a look at negative earnings revisions from companies, right? There's been a very, very big tick up in companies reporting much weaker than expected. They killed it on earnings, to your point, but then their forward guidance was so terrible that it just crushed the stocks. Netflix was a good example of that. The earnings were okay. It was their forward guidance that killed them. And, we saw this from company after company after company. Amazon was another one. And these stocks were getting clobbered. They were down 10, 15, 20%, and then went lower even after that. But let's solve a couple of myths here real quick. One is I read this article today that said, yes, we've had 2 quarters of negative GDP growth, but that doesn't mean we're in a recession because, the economy, the consumer has so much cash on their balance sheet. They're completely ready for this whole recession. So yeah, we had 2 negative quarters of economic growth, but it'll be okay because the consumer is so well heeled. They're about to pick up spending and it'll all be fine. That's a complete fallacy. So, we talked about this before, a big bunch of those savings are held by the top 10% of income earners, not the bottom 90%. And, we run this analysis. I was actually on Charles Payne yesterday talking about this very thing, saying, if you take a look at the average household and their standard of living, so if you take the standard of living and run it back to the 1960s and inflation adjusts that over time, that gap between just what they have in income and what's reported as savings requires an additional $6,300 a year in debt just to maintain their standard of living. And this is why we're seeing personal consumption expenditures decline. We're seeing retail sales decline. We're seeing, all this kind of weakness on that spending front because their wages aren't keeping up with the cost of living. And now they're having to make those decisions about, well, what am I not going to buy? Right? I'm not going to travel this summer. I'm not going to buy these things. I got to just try to get by right now. And they're not set up for it. You just sent me a great article last week that I'm converting into an article for our website, giving statistics about the average household savings. It's just, dismal, when you look at the average household.
That's point number 5 here on the list. Just so you know.
Yeah, but it's an important point because it feeds into this psychology. Now, the other myth is, and man, people have got to get this out of their head because this gets repeated ad nauseum on the media. They say the stock market is not the economy. That is a true statement, except it's totally erroneous. Because yes, the stock market's not the economy, it's the stock market, and the stock market can do things sometimes that's not reflective of the actual economy in the short term, i.e. we can have little, like bubbles caused by a lot of monetary infusion like we saw in 2020, 2021. But historically, going back through history, there's a very high correlation between 2 things. One is economic growth. The other is earnings. And the reason that those 2 are highly correlated is because the earnings and revenue for companies come from where? Economic activity. The stock market doesn't exist in a vacuum all by itself. It is directly tied to the incomes and revenues that are generated by the economic activity of what, you and I are spending in the economy. We go out and buy a new Apple Watch, or we buy a new Mac, or we go buy a new car. That's where those companies' revenues come from. They just don't magically show up somewhere. So yeah, markets can deviate because we get very excited at times and we run stock prices up well ahead of valuations, well ahead of earnings. This is how we get overvaluation. Then there's points where the stock market can run down and be more depressed price-wise than what earnings are truly showing. And that's how we get undervaluation and get those good buying opportunities. But the stock market may not be the economy, but the economy and the stock market are very integral to each other. And you can't dismiss those 2. So if we're talking about an economic recession, it's going to impact the stock market because ultimately investors will reprice earnings to adjust for that decline in earnings relative to the price they're paying for that future form of cash flows.
Absolutely. And just to even simplify things further, really the relationship there is the stock market is a multiple slapped on the earnings that the economy is producing. Right?
Same thing. Yep.
And because of that, the stock market actually is supposed to be a bit of a forecasting vehicle because the stock market really is pricing forward earnings expectations, right? So if the economy is likely to perform less well in the future and analysts are doing their jobs, right, then stock should actually correct before the actual economy slows down. They should be predicting that in advance if they're doing their job right.
And they do. And if you go back in history and look at, we talked before, by the time the National Bureau of Economic Research dates the recession, right, it'll be 2 quarters from now or 3 quarters from now. Right. And they'll come back and say, oh yeah, the recession actually started in January of 2022, right? And we'll go, oh, well, thanks for telling me now. But the stock market was already going down. If you go back through history and look at where the National Bureau of Economic Research actually dated the recession. So on what date did they say the recession started? So an example we talked about before here in our conversations, in December of 2008, the National Bureau of Economic Research came out, the recession started in December of 2007. So if you waited for the announcement of the recession, you completely missed the bear market, right? But the bear market occurred and was telling you we were in a recession. It just hadn't been dated yet. And if you go back through history, there's always about a 6 to 9 month lag, sometimes a little bit more, sometimes a little bit less. But there's about a 6 to 9 month lag between the actual, downturn in the market and when the recession actually gets dated. So again, this is why, as investors, we have to pay attention to the real-time data, pay attention to what the market's telling us. And the market's telling us that earnings estimates are too high. Those have to come down. The economy is a lot weaker than what we currently expected is from the trailing data. And investors are pricing all this in right now.
Yeah. So very, very well said. I think the important thing just to underscore here is as the conditions deteriorate, there are certain parties that have to be involved in that, right? There's the companies that have to say, hey, we know our business better than anybody else, and we think this is what's going to happen going forward. Then there's the analysts who have to take the company information and then run that through their models and say, okay, we think a fair price for this stock is X. And then there are investors who have to consider all that data and then make up their mind at the end of the day. And just one of the things that we're kind of putting our finger on right here is we think it's pretty clear that the fundamentals are deteriorating. A lot of companies are beginning to agree with us. The analysts haven't yet fully corrected their models yet. So there is a bit of an arbitrage moment here right now where I think those paying attention are saying stocks are probably still on average valued too high right now, given what we think the revisions are going to be. Now, time will tell whether that's right or wrong, but we're in this really sort of interesting time right now. For whatever reason, the analysts have just been reluctant to pull those forward earnings down into the world of reality yet.
Well, no, and look, if you want the world's best indicator for when to buy and sell stocks on a longer term basis, right? So if you want to be a buy and hold investor, nothing wrong with that. Invest for the long term, it's awesome. But you still got to manage that risk, right? You don't want to spend 5 to 7 years getting back even after a big bear market drawdown. So if you're the type of person that wants to just kind of buy some stocks and sit on them, but know when that kind of moment is to come out of the market and wait for your next opportunity, all you have to watch for is the annual rate of change in forward earnings versus the stock market. And what you'll see is that pretty much every time those forward rate of earnings begin on a year-over-year basis begin to fall, the stock market tracks it very closely. And so when those revisions are negative, that's when you want to be out of the market. And we're very negative on those revisions right now, and those are going to continue to get worse. So until those revisions go back to being positive, you can just kind of sit on the sidelines and wait.
Hey, that's a great indicator. So just folks watching, we'll make a note here to make sure that we bring this topic back up when the indicator's doing something different than it is right now. In other words, signifying a major shift. All right, I got another topic I want to go to real quick though. The way you described the NBER in terms of just always being way late in terms of reporting the obvious of what was going to happen. It kind of reminds me of the guy that shows up as you're watching your car getting peeled off the tree by the tow truck, who, sipping his coffee and says, hey, buddy, you should watch out for that tree.
Exactly.
Hey, information that would have been useful like 2 hours ago.
Exactly.
So,
Bill Engvall, a comedian, he has a great set he does called Here's Your Sign. And it's kind of like that, your car's wrapped around a tree and somebody walks up and says, hey, did you wreck into a tree? It's like, yeah, here's your sign.
Yeah.
People ask stupid questions all the time, but it's true. I mean, most of the data that we get is not really very useful in terms of, managing money and all that. Economics is important, but it's more about, and this is what our job is in our shop, which is to take this real-time economic data and then say, what does this mean over the next 3 to 6 months? And look, it's all a guess, right? I mean,
it's all probabilities.
Yeah, it's all probabilities and statistics. And we know that, and this is why we build a bunch of composite models. We have a what we call an economic composite index, and I've been posting this a lot lately in our newsletters and blogs, because it has a very, very high correlation to real-time economic activity. It has 100 different data points in it, covers everything from lagging indicators to leading indicators, manufacturing to service. So it's a very broad, very complete indication of what happens in the overall economy. And it also has a very high correlation to, and this is more real-time, but it has a very high correlation to the very best economic recession indicator, which is the 6-month rate of change in the leading economic index. It is that one indicator is kind of like the 10-year, 2-year Treasury yield curve. It has a almost perfect prediction of when you're going into recessions. Both of those indicators, our real time and that LEI 6-month index, have now turned negative. So we've got everything set up for the recession to be announced. It just hasn't been announced yet. But this is why it's important. We've got to look at this data, make some assumptions, and again, it's all about statistics and probabilities. We may, one thing that bothers me, Adam, right now is that there's too many people talking about a recession. We're talking about it.
I know.
Everybody's talking about it.
I know that bugs you.
It does, because recessions are never this well forecast. Maybe this time is different. I don't know, but this is statistics and probabilities, and the data says we're very likely going to be in a recession. So we've got to kind of manage portfolios for that. Is there a possibility that we could not be in a recession? Sure. We're going to need something really soon to turn that around. Like the Fed's going to have to stop doing what they're doing and pivot. That could be the case, but I just don't see that happening right now.
Yeah. And at the end of the day, to the average person, to the viewer of this channel, it doesn't matter what they call it. It matters what it feels like and how it impacts your life directly, right? So to a lot of people, that might end up feeling like a big recession, even if it never gets called one, right? If right. Conditions continue to deteriorate the way that we think. And there is a topic I'm trying to get to here, but real quick, I'll put up one stat here. It's a chart I tweeted out, I think yesterday. So I think I've mentioned that I've been sort of following layoff trackers and whatnot, right. Because that's a big concern of mine. That's really what kind of keeps me up here, is that right now the narrative is still more openings than job applicants, and anybody wants to get a job and get one, and it's the Great Resignation and all that type of stuff, right? And I feel like this thing can turn on a dime if conditions continue to deteriorate the way that they are, and that we are going to very quickly potentially flip into a scenario where it's a massive jobs drought. The big question is just, hey, I need some income to survive this, right? And if I get laid off, obviously I don't have that income anymore. So I'll put up the chart here, but it shows from this one layoff tracker, it tracks tech layoffs in July. So last July, a year ago, one company reported layoffs last July. In June, and the chart wasn't even fully complete when I took the screenshot here, 197 did. Yeah. Right. So it's just showing how quickly this is building steam.
But that's the way it always occurs, right? I mean, you always get this very rapid tick up in layoffs when they start. Just Mark Zuckerberg and Facebook, Meta, whatever they call themselves today, just started talking about, hey, you know what, you might want to start considering if you don't like it here, this is a good time to voluntarily quit, because layoffs are probably coming. And so, you might want to take your opportunity to slip out the door here. The problem is where you're going to go now, right? Because everybody's putting on hiring freezes and everything else. I want to say something though, real quick, because we've talked about this before. I'm very suspect of these job openings numbers and a lot of these employment numbers for a variety of reasons. One is how they calculate the data. Not saying that it's intentionally incorrect, but I think
there's a lot of potential double counting with all the different job sites we've talked about.
Exactly. The other thing too is, though, that when we start talking about unemployment, one of the things when we get that monthly unemployment report, there's what's called a birth death adjustment that is included in that. And that generally adds anywhere from 100 to 200,000 jobs, to the rolls. And what that calculates is, and that's supposed to be an estimate for all these people that are starting a business. So Adam and I, we decide one night that we're going to go start a business selling widgets online. And so what we don't, we just go form our corporation and, we go to work and we don't really tell anybody what we're doing, right? We don't report that anywhere. We just kind of form this entity and go. And, so we've got this job. And so what they're trying to capture is all these people that are starting businesses, this birth. And then of course, there's also businesses that are going out of business, and that's the deaths. So we have births and deaths every month. And surprisingly, there's always a lot more births than there are deaths. And so we always add a bunch of numbers to the employment roll. And ironically, on months where we see a very kind of weak employment report, there's a big input of this birth death adjustment. Now, here's the funny story about this, or I shouldn't say funny, but the reality of this. There's actually, so if you take a look at the Census Bureau data and the Small Business Association data, they track how many small businesses are open or how many corporations are formed. So there's like 32 million corporations in the US. Now, here's your pop quiz for the day. Out of the 32 million businesses in the US, how many of them actually have employees? Want to take a guess?
I mean, more than just a solo operator?
No, actually have employees, period. Like have one employee or more. How many do you think have one employee or more?
Okay. It's going to be a lower number than most people think. So yeah. I don't know.
6 million.
5 million. Pardon me?
5. It's 6.
Okay.
So all the other ones are, family trust, estate planning tools, okay. People form a corporation.
Literally a paper shell, basically.
Yeah, paper shell stuff. People form entities. They form an LLC and stick a house in it, right? Just to protect it legal wise. But see, all those LLCs and small businesses and blah, 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 all those count as a business, right? And so the entities look at that and say, well, we're creating all these jobs. But if you take a look at how many small businesses actually have employees, that number's been 6 million for a decade. And actually there's fewer small businesses being created and more deaths over the last 6 years, right? We've had more businesses going out of business over the last 6 years than we've actually had them being created. So again, when you take a look at, and the point about this is when you look at the employment rolls, the employment data isn't as strong as it is because we've been adding all these people to the roll that really haven't existed at all.
Right. Yeah. And so you did a really good job of explaining it. I've always just sort of thought of it as this giant fudge factor, which it is. You're saying it really is. And it's one that generally makes things look a little bit better than not. And sometimes the fudge factor, the birth death, can mean the difference between a positive jobs report or a negative jobs report, right? So your point is it can be pretty influential. We just don't know if it's really based on anything. And it's hard to a certain extent, to your point, because you're like, hey, there's a lot of people that just start something, and how do you know, who've done that if they're not doing all their regular reporting? And on the deaths part, it's not like companies, fill out a form and say, oh, I've died here, right? So if a company hasn't been active for 6 months or a year, is that a dead company, or is it just a small business where someone's distracted for a while, but it's going to come back to it, right? So
yeah, exactly. There's all these things to it. And that's my point is that if we take a look at the differential of actual employees, and I went back and I did the work on this a while back, there's about 10 million people in the US that have vanished from the rolls. It's like, I can't find them. And a lot of it has to do with these adjustments and things that we do, but there's a big gap between the number of people we say are employed and the actual population. So, we track the population. We know what the population is. We know when the population turns 16. And the one thing that we can track very closely is the demographics of our country, because we have all kinds of records on that, who gets born, who dies, all that type of stuff. But when you calculate how many people should be working in the economy because they're over the age of 24, and how many people we say are working in the economy, there's about 10 million people that just aren't counted at all. And I have no idea where those people are.
Yeah, I have a potential idea, and this is a rant for a different day, because we could spend the whole time on this. But one of the things that really bugs me about the reporting of the employment rate is the huge number of people that are identified as outside of the workforce.
Yeah.
It's like 100 million at this
Yeah.
point. I mean, it's literally like a third of the country. And yes, some of them are young and some of them are too old to work. But there's a big chunk in there that, if you have been unemployed, and I can't remember what the length of time is, but it's some number of months, they basically just say, well, you're unemployable. We're going to take you out of the denominator that we're using here, right? Yeah. So there's a lot of miscounting going on there. But I know a big issue, at least a few years ago, when I looked at this more closely, was disability. That there has been an explosion of people getting, a doctor's script that says, hey, you can't work for whatever reason, right? And it used to not be that many people. And the last time I heard it reported, it was pretty close to 10 million.
You know when that started? There's a very interesting chart. I published this about 2 years ago. I was looking at that very same thing. Two things went off the rails: student loan debt and disability claims. Now, think about this, right? If I get disability claims, that's free money from the government.
Right.
I can use student loan debt for pretty much anything. I don't have to go to school. And, it used to be in the old days when you actually had to go to the bank and get a student loan. It was specifically for tuition, room and board, and books. That was it. And you had to qualify for it. And you had to have co-signers and all kinds of stuff. When the government took it over, they said, hey, here's the money, which is why tuition went through the roof. But people were taking out student loans and using it for everything but college. And they weren't even going to college in a lot of cases. They would just sign up for classes so they could get the money, and then they never went. And so and this all started in 2009. Both of these issues started in 2009 when the Obama administration came out of the financial crisis in 2008. And the Federal Reserve started doing what they were doing. The Obama administration took over the student loan debt, and we relaxed all of the kind of oversight on things like disability, the lending became a lot Social Security. Tight. Yeah. I mean, you just basically, if you were an illegal citizen, no problem. Here's Social Security. You can apply for whatever you want. And we just completely relaxed this oversight. And man, these things the claims, I mean, everybody that was walking around didn't have a job. They just claimed disability and they got a script for it and they got money. And this is why we saw that explosion on really all sides of that debt structure.
Yeah. And again, I'm trying to avoid falling into the pit of this rant because there's so much fertile ground there. But the last point I'll make on it is the one of the documentaries or sources of information I used when I kind of dug into this a couple of years ago. They uncovered that there were doctors in these certain areas who were basically like disability factories. Right. So, you just had to know the right doctor who was willing to, for whatever price, he asked for, you could basically get a disability claim.
Pretty much you just went to a doctor's office, said my back hurts, and that was it.
Yeah. So anyways, rant for a different day. Yes. Okay. So I've actually
that, ladies and gentlemen, is how you get to 30 trillion in debt. Okay, go ahead.
Yeah. Okay. I'm working my way up to a bigger issue here, but real quick before we do, I want to ask you what trades you guys have made recently, if any. But before we get there, I just did an interview with Steve Hanke, who's a very prominent economist, Johns Hopkins, and he provided what could be a very important part to the puzzle here that I didn't have before. But I'm kind of scratching my head because to a certain extent, it kind of contradicts where I think things have been headed, and I think where you think things have been headed here, Lance. So I just want to kick it around for a moment here, and I'm not in any way trying to say that Steve's wrong. I'm not at all. But you and I have been trying to prepare people for disinflation, right? Which is, hey, at some point here, the monthly reported CPI is going to start coming down. We're not saying prices are going to go lower necessarily, but we're going to say the rate of increase in prices is going to start to moderate. Steve would agree, but he would say not by very much. So he's predicting that we're going to end this year at 7% CPI, December of 2022, and it's going to remain pretty high through the following year. And it's going to end around 6% in 2023, which to me is still pretty high. Yeah. And his reason for this is, I've used the term the pig and the python, right? We issued all of this stimulus, both monetary and fiscal, over 10 trillion combined, never been done before. And at some point that pig of money makes its way through the systemic python, and you don't get that support anymore, and everything it was propping up, from stock prices to economic activity and whatnot, goes away, right? And I think we feel like we're beginning to see, like, that's a big contributor to the slowing economy that we're seeing and the recession fears that we have. Steve says there's a lot of stimulus, there's a lot of pigs still left in that python. He uses a monetary bathtub analogy. And what's compelling about what he does, besides him just being very smart and the 50-year experienced Johns Hopkins economist, is he's got one of Milton Friedman's equations in his corner, and he actually walks through the math and basically says, when I interviewed him a year ago, when CPI had just gotten to like 4.5 or 5 or whatever, he was predicting 9% CPI, which sounded crazy back then. But he said, hey, the confidence that what gave me the confidence to make that claim was just this simple equation. And if we put X amount of new money into the system, this is what I think, all things largely else remaining the same, it mathematically has to happen. We have to get this 9% number eventually. So that's why he's getting this 7% and then 6% number from. So it's kind of like, what's going to win out here? Kind of like the purity of the math, or a lot of the stuff that you and I have been talking about here. Just curious, do you have any particular reaction to all this?
No, look, trying to predict anything out more than about 3 months is kind of
hard.
It's very hard. And he could very well be right. And I'm not one to argue with Steve. He's way smarter than I am. So,
sorry to interrupt, but one other piece of information I should have mentioned is he pegs a 70% probability of a recession. And honestly, I think he probably thinks it's higher, but the range he looks at, nobody else is higher than 70. So he's picking the high end of the range. Yeah.
I don't know. JP Morgan came out with 85, so I think he's okay.
Oh, well, all right. There you go.
There you go. And then, no, look, there's a lot of things that affect inflation over time. And one is how we calculate inflation. And again, we're always kind of adjusting with these numbers in the inflation measures that we look at. So, we have this hedonic pricing and other stuff. So, a couple of things are going to hinge on whether or not, inflation stays high. So first of that is this homeowner's equivalent rent, right? So if housing prices stay elevated and don't come down, and we don't bring rents down through a normal course of a recession, just rents stay high, then inflation is going to remain high. It's not going to come down. If you take a look at M2 money supply relative to inflation and advance M2 about 9 months, there's a very high correlation between the ebb and flow of M2 on an annual change basis and CPI. So CPI is currently, peaking up here at, 8.5, 8.6. Monetary the M2 supply number rate of change recently peaked there. Just recently peaked there as well. Advance at 9 months, and M2 money supply is back down to about 4% inflation. So over the next 9 months, what M2 is telling us is that inflation is going to fall to between 4 and 5%. So, there's a very high correlation between CPI and M2, and you can kind of watch that, and it tells you a lot. But there's a lot of factors that all feed into this. Oil prices, what happens, with the supply chains, do those free up at some point? Do we get more supply into the system? So there's a lot of things that could lead to inflation staying high or having a bigger contraction or disinflation in the economy. But, historically, if we're talking about a recession, recessions bring about disinflation because of the very simple basic equation in economics of supply and demand.
Right. It's demand destruction, right, which is why we spent so much time talking about that.
Yeah. And that's just math. I mean, so again, not arguing with Steve at all. And again, he's been right and he could very well be right. But again, I think there's a lot of factors out here that are too hard to predict 9 months out, much less 3 months from now.
Okay. Yeah. And to be honest, he is predicting disinflation, right? It's going from 8.6 down to 7 by the end of the year, right? Not much, but he is predicting some. And the reason why this is important, folks, is, even though there's maybe a bit of a disparity between perhaps how fast things could cool versus how Lance and I see and what Steve sees, Steve still thinks it's stagflation, right? Which the stag part means stagnant economic growth, right? And that still brings you to layoffs. That still brings you to lower housing prices, things like that. because you mentioned housing, I just had one quick headline here, Lance. I was just going to read this real quickly from a report that just came out today. The slowing suggests that, quote, we're at a tipping point in terms of home price growth. Selma Hepp, deputy chief economist at CoreLogic, told Yahoo Finance. We do expect going forward that deceleration in home prices is going to take an even harder turn, and home prices will slow down substantially by this time next year. So now the actual experts that have sort of been not wrapping their arms around the potential for a correction in home prices, it's now at the point where they can't deny it anymore, and they're now beginning to jump on the bandwagon here, right? So where I'm going with all this and why I wanted to take this path is I put out a video earlier in the week. I'm going to put up a link to it here, talking about how just incredibly unprepared Americans are for retirement. These are some of the stats that you'd mentioned earlier, Lance. So just a couple quick ones off the top of my head. The majority of Americans have no retirement savings. Okay, and that's surprising and shocking, but not terribly. I mean, all American adults, sure, you got a bunch of 20-year-olds in there. They haven't started saving yet, right? So what's important is to look at the cohort, right? So if you look at the cohort that's 55 to 65 years old, right? The one that's just approaching retirement age, the one that should have the most assets now saved up, right, to fund the rest of their lives. A full 49% have $0 saved. Okay, so half of them right off the table have nothing. If you look at the remaining 51%, the median savings account of that 51% is about $134,000, which isn't nothing. But if you're 65 years old, that's not going to last you the next 15, 30 years of your life, right? And for people that are thinking, okay, well, you know, a lot of folks can rely on Social Security and Medicare. Well, the average Social Security monthly payment is $1,600. That's $1,666.49, right? You can't live off that, folks. In fact, the average rent in America right now is $1,900. So it doesn't even cover the average rent cost, right? Moreover, the Social Security trustees just released their annual report. They are saying that the trust fund is going to be insolvent in 13 years by 2035. So even that meager amount may not be there, or at least in that size, be reduced in just 13 short years. That's if nothing happens, and we can have a whole debate over what the government might do between now and then. But on the current trajectory, on track to be insolvent in 13 years. Medicare is even worse. It's on track to be insolvent in 6 years by 2028. Yep. All right. So just horrifying stats, to be honest. I mean, this is a massive economic and social crisis, and we're not even talking about it yet. As a nation, we haven't even admitted the problem yet here. So, Lance, I see you nodding as I'm seeing all this. Where I'm going with this is just we are so unprepared for the future. And if we now enter into a recession that has any real teeth to it, it could be really uncomfortable for a lot of people in society coming up here. And I don't want to be selling gloom and doom, but I just see enough probability here of some rough times ahead that I just want to make sure that we're opening as many eyes as possible to people that now is a good time to take precaution for what could happen down the road. Not saying it's absolutely going to, but what could. I see you smiling as I'm saying all this. I'm sure you're having these discussions all the time with people, Lance, but what's your reaction?
No, I'm sitting there just, thinking about, articles I've written lately about this. In fact, if you go to our website, realinvestmentadvice.com, you can just look up, I just recently published this maybe 2-3 weeks ago. It's called Whistling Past the $96 Trillion Graveyard. $96 trillion is the unfunded liabilities of Social Security, Medicare, and basically our social safety net. And, people keep going, well, government's going to do something, right? Well, we just just recently added more people to the Social Security roll. And every time, and this has been going on since the 60s. And it's all in good, it's all set up in good nature, and we want to help people. And so, we add widows and orphans to the Social Security rolls, and then we add, firemen and pension other people to the Social Security rolls, and then we add more people to Social Security rolls for some reason or another. And so every administration comes along and they go, well, we need to give more people money, so let's add more people to Social Security, and we keep doing this. The problem is demographics. In 1939, when we were passing, Social Security and really getting it up and running, there were 16 people paying into Social Security for every person that was taking out of it. Today, that number is less than 2 to 1. And it's interesting. We've had this conversation here on the show before, but there's a very big issue at hand in terms of demographics, which is our birth rate in the U.S. And more people are opting not to have children. More people are opting to have alternative lifestyles that don't produce children. And so lots of conversations recently about abortion, right? Because of the recent Supreme Court ruling. But that all provides less bursts within the economy. And there's an old saying is like, if you want your economy to be stronger, have babies. China ran into this problem with the one-child policy, right? And just basically devastated their economy for a long time. They've had to try to reverse out of that now.
Yeah,
and
they've hollowed out their entire demographic pyramid. I mean, they've got a massive reckoning ahead.
Exactly.
And we've done a little bit of the same, not as much as them, but yeah.
Yeah, but we've got the lowest birth rate since 1940. So, Japan's got the same problem as well. And you can look at China and Japan and see exactly where we're headed. And Japan has a very big social pension system, just like we have in Social Security, that is entirely supported by the government. It's just, and if the government doesn't support it, it's a problem. But that's why we always talk about Japan. It's basically a fly looking for a windshield. We're kind of very much in that same situation. My partner and I, Richard Rosso, we constantly have this debate at the office because he's like, well, Lance, if the government doesn't, handle Social Security, you're just going to have people showing up and you will be stepping over the bodies in the streets because they all depend on Social Security. Hey, I get it. But, the numbers don't lie. You cannot continue to pay out what you're paying out in Social Security based on the simple math of what you've got coming into the system. And at some point, you're going to have to, there's two choices. At some point, you're going to have to make very tough decisions about who gets money from Social Security and who doesn't, or those choices are going to get made for you through debt structures, people saying, hey, I don't want your debt anymore. The same problem Japan's going to have down the road here sooner than later. But this is going to be the problem that is facing the economy. And again, and this is why we talk about going back to the original part of this conversation, another article I wrote was talking about, we've had, and this goes to the heart of why buy and hold investing doesn't work. And, just, buy an index and hold on to it, you'll be fine over time. If that worked, if that really worked, if I could just buy an index and stick a little bit of money into it, and over the long period of time, I'm going to be fine. If that really worked the way it was supposed to work, then why is it after three of the biggest bull markets in history from 1980 to present, that you have so many people, according to your own statistics, Adam, that either have zero savings or have less than 1 year's worth of savings in the bank?
Yep. Well, and so I want to get here to some really practical, tactical stuff for folks, but to that point, it's multifactorial to your point, kind of how we ended up here. But there were two things that were really interesting and they're worth touching on briefly. And one we don't really even have to, which is the massive wealth inequality that's been created by the Federal Reserve. Right? We've railed about that enough. But the key thing with that is, not only did the Federal Reserve do a massive wealth transfer with its policies into the pockets of the already rich, but they've also created huge inflation, right, which is raising the cost of living. So you've got the worst case scenario for the middle and lower classes, right, where their real wages aren't going anywhere and their real costs are rising, right? So there's just less and less available to save, right? A big part of it too is human nature. It's a story of human nature in two ways. And I'll be really brief on this because I kind of go deep into this in the video that I did. There had always been government pensions. They've been around for millennia. Actually, the Romans started them, but America had started offering pensions in the Revolutionary War. And then over time, state and municipal governments adopted it. But in the late 1800s, the private industry said, hey, we'll take a page from this book. And they started offering corporate pensions and people loved it. It was a great way to attract talent, right? Hey, come work for us. We got a generous pension program, right? That's how they competed. But then by the 60s, by 1960 or by the mid 60s, 50% of all private workers were covered by a corporate pension, which is amazing when you compare that to today, right? And the reason why, and this is why I'm flagging it, is the corporations they projected out at the future liabilities that they were taking on here. And they said, oh my God, like these are ballooning like crazy. We've got this baby boomer generation that's just hitting employment age. And they're the biggest ever in history. Like this is going to totally bankrupt us. Like all our profits are going to be to paying these people's pensions. So around the same time, probably not very much of a coincidence, you had ERISA or whatever it's called. You had the launch of the IRA, you had the launch of the 401k a few years after that. And it was sold to workers as, hey, this is putting your retirement in your hands. You don't want to have to depend on your company to be a good steward for you. Some of these, you don't want the guy disappearing in the middle of the night with a corporate pension fund. If you want more in retirement, well, you can just increase your contributions. Like you're in the driver's seat. This is great. And people kind of liked it. They said, oh, that sounds cool, right? So we started this grand experiment really right as the baby boomers hit adulthood and began working in mass, right? And of course, the corporations loved it. They were like, phew, we got all of that stuff off our books. And now we can funnel all our profits, everything to the bottom line, and we can, pay ourselves big salaries and buy back our stock and make a ton of money, right? So it was a massive transfer of liability from the corporate balance sheet to the household balance sheet here, right? And it was sold as, hey, this is all great for you. Well, this 40-year experiment, we're now getting to the point where we're finally seeing the end results of it. And it's really bad, where people didn't save. And they didn't save for some of the reasons I mentioned earlier, but we also got to own it too, that human nature, we're wired to maximize today, right? And so I can either save money today in my retirement fund, and yeah, I guess I'll have it decades down the road, or I can do something fun with it, or bills are tight this month, I'm just going to push towards that, right? And we just didn't save nearly as much as we should, in addition to all the other issues that we had. So that's kind of how we end up in this space here. So now the big question is what to do about it, especially if we're potentially entering an era where we're not going to see the appreciation that we saw over the past decade or two, right? We're not going to have all that good juice, pushing everything up, all that intervention. And as some of these chickens come home to roost more, and we have to make our way maybe through a real recession that lasts more than just 3 months like the last one did or whatever. Yeah. How are people who are watching this gonna be good stewards of their capital here? So I'll let you talk, but real quick, I know there are 3 really important factors, right? There's how much you put away, there's how much you take out, and those 2 are 100% pretty much under your control. And then in the middle, it's how those assets are managed in the interim, right? So those are the 3 important levers to look at. But you talk to people about this all day long, Lance. What are your thoughts?
Well, I'm actually writing a piece right now. I'm going to convert it to an ebook, I think.
Oh, you're being serious?
No, I'm being serious. I wrote this piece called "The 10 Immutable Laws of Money," and it's a very basic primer about how money works, and if you want to save money and grow wealth over time, it's kind of goes through the 10 kind of laws about how this works. And stuff you don't want to hear, right? I tell you stuff in this piece that is the last thing you want me to tell you, which is like, look, you don't send your kids to private school, you send them to public school. Mm-hmm. Right there already, people are like, oh my God, I can't do that. You don't pay for your kids' college, not your responsibility. That's their responsibility. But these are all things that as we go through talking about how money works, the problem is for most of us, we're always trying to keep up with the Joneses. We always got to have the fancy car. We got to have the bigger house. The median house right now is $350,000. I mean, we complain about, how we need more socialism in this world because capitalism isn't working. And yet we're running around buying the average house we're buying is $350,000. Poor people, what we consider poor in America is if you're making $30,000 a year. And we go, wow, those people are really poor. They've got $30,000 a year. Do you realize that they're in the top 1% of income earners worldwide?
Yeah, I know.
And so our perspective about money is really skewed to a large degree. By the way, I got criticized on the show last week for being an elitist, by the way.
I'm glad you took your top hat and monocle off before we started.
I know. I hate, I had the top hat ready to go. I was all set up. But people forget I lived out of my truck for 3 years. So, it's this is all part of the process. And again, when we look at how money works and the decisions that we need to make to build wealth over time, there's a great book. It needs to be updated, but a great book called The Millionaire Next Door. Go read that book. Yeah, it's a great book to kind of get your perspective on things. But when we talk about the 401k plan, even the guy that created the 401k plan, and went through all the talked to the IRS, got the rules set up, created the whole structure, he says that it was the worst idea ever because it wasn't meant for corporations to go, oh great, here, there you go. Yeah. You deal with it. I don't want to deal with your pension plan anymore. And by putting it into people's control, they made all the same investing mistakes they always make, which is why after 3 major bull markets, most people don't have any money. They sold high, they bought high, they sold low. They didn't get in the markets at the right time. They didn't contribute. They didn't save. 401k plans are exactly the same way. We've gone through the stats. Out of all the people employed, only 25% of the people that actually have jobs actually contribute to a 401k plan.
Right. They don't use
it. It's terrible. But this is what we've done. We don't. I've talked about before about creating a financial education class, which I think would be a huge benefit because people just don't get financial education. And again, you're not going to want to read my ebook because it's not how to get rich quick. It's not going to make you wealthy overnight. It's all the rules you need to know to build wealth over a lifetime. But if you follow it, it'll work.
Right. It's the hard truths. Right. Okay, great. Well, so let me mention here that we've now asked the audience several times if they'd like us to do some special webinars on a certain amount of topics. I think the first one we ever talked about was doing a retirement webinar. And Lance, I think we've agreed with your team that we're definitely doing it. We haven't picked a date yet, but my hope is that it'll be soon, meaning in July or August at the latest.
Probably August. I'm going to be out of office for the next week, so it'll probably have to be first week of August.
Okay, so we'll lock in the date with Lance. I'll let folks know here. Real quick, if you send an email to retirement@wealthion.com, I'll put you on the list of folks to be notified when we've picked the time, so I can let you know when the time is and give you a link to how to register for it. I mentioned that on my earlier video I did this week, and we already have like 70 people or so, Lance, that have already been a hand raiser. So I think this one's going to be really interesting or of great interest to folks. Okay, so folks, we will give you that webinar that goes specifically into, okay, if you have assets, this is how you should be approaching creating your retirement plan. These are best practices. These are pitfalls to watch out for. Anything else, the team, I'll actually let you sort of pre-sell this thing, Lance, because it's going to be the guys from your team who do this regularly, right? So give us just a quick backstory.
Yeah, no. So basically what this, kind of course goes through is all the things you need to know to prepare for retirement, not only just how to invest for retirement, getting ready for retirement, how to invest in retirement, but also how to maximize your Social Security. When should you draw? A lot of people are running out, taking Social Security at 62 is like immediately, as soon as I can get to it, I'm going to take it because it may not be there. You wind up leaving a whole lot of money on the table, like hundreds of thousands of dollars on the table by doing that. Spousal benefits, income generation and retirement, how to maximize income without impacting Social Security payments. Medicare, Medicaid analysis. So, it goes through so many different facets of things that you need to know, particularly as you get set up for retirement. It doesn't mean you have to be in retirement to benefit from this, but it's things you need to know as you head into retirement. Also, a lot of people are shoving everything they can into a 401k plan at work or an IRA, trying to get those tax deferrals. That can actually be very bad for you down the road, because when all that money has to be taken out because of RMD requirements or just living requirements, that all comes out on a taxable basis. We talk a lot about having 50% of your money in a taxable account versus 50% being in IRAs. And this way, in retirement, tax rates are going to go up. There's no way around. We can't raise taxes in the future. We've got too many bills to pay, too many bonds to pay off. Rates are going to have to go up. So as rates go up, you can mitigate some of that tax increase by drawing part of the money you need to live on out of your taxable account that you've already paid taxes on and then balancing that off with your other tax deferred money so you can limit your tax liability in retirement. So they go through all of this. And again, it's normally about a 2-hour seminar. We're going to condense it down to about an hour 15 around there to, for your audience.
Okay, great. But we'll have a lot of Q&A afterwards too. So
sure, absolutely.
Okay, great. So I'm going to leave it at there in terms of what people who, have assets and a hopefully dependable income can be doing now to prepare for retirement. Here's something that I want to veer into, territory I want to veer into just for a moment though, which is the people, if you have people in your life who have not planned for retirement. So I just gave you the stats for the people 55 to 64 who haven't saved, right? So half of them have zero savings. A good chunk of the remaining half have insufficient, right? So right now there's over 50 million people age 65 and older in America. 10,000 people per day turn 65 from right now until 2030, right? So this is still a tsunami of people coming, right? And if those stats hold, more than half of them, a good deal more than half of them, don't have enough saved up to fund the retirement that they're heading into, right? So this is a really big crisis. I'll wax personal here for a moment. I have a relative who I've spent years with, basically dealing with helping them basically navigate and survive their elder years with having no assets and no income. And I'll tell you, folks, it's not a situation to aspire to. It is hard. There are not many options, and none of them are really good. And one of the reasons why I want to flag this for folks is twofold. One, there actually are resources out there that can help make things a lot easier, and I'll mention a couple of them in just a moment. But there's also just sort of a family dynamic that comes into play, where understandably people who are older and haven't planned, they're scared. They can be resistant because they don't necessarily want to acknowledge reality, step into reality or whatnot. They're afraid of the downshift of the life they lived versus the way things are now and whatnot. And it can be a vortex of drama and dysfunction that can wreak havoc in families. And so what I'm trying to really underscore here for folks is, if you have anybody like that in your life, or if whatever happened in life, you're facing a future that you don't have the full funds for, both people will be extremely better served by planning for it now with family and starting the dialogue and saying, look, let's try to put kind of emotions aside for a second. Let's just talk about the actual facts. How big is the shortfall we're talking about? Let's start sort of getting creative about how we can fill those shortfalls. Can we do it with family support? Can we do it with government subsidized programs that are out there? And there are a lot out there, but they're hard to navigate. And so the sooner you can do that, the sooner you can take the real emotional trauma and fighting and resentment and all that stuff that can very naturally build from all this. The more out in front of that you can get, you'll be serving everybody's interests better here. So Lance, again, I know you probably see this happen all the time in your line of work, but anything you want to add to that?
No, it's right. And what's interesting is that we're facing what we call the sandwich generation. And what that is where we're going to see more and more people. So you were just talking about baby boomers. I'm right on the tail end of that. So my 65th birthday is 2030. So, but we're going to see more and more individuals in that millennial phase that are having to both take care of parents as well as their children.
Yep.
And they're going to be sandwiched in the middle of this and they're trying to navigate their way to retirement while they're having to pay for their parents and support their kids at the same time. And this is one of the things that we talk about a lot. And I know it's not popular, because I can tell you it's not popular when I tell our clients and prospects this. When they sit down, it's like, okay, we've got to pay for our kids' college. I go, no, you don't, and you can't afford to, because otherwise you're gonna be living with them. And you don't want to do that. You don't want to be that burden on them when they're trying to get their lives going and having kids, and you can't afford to live because you spend all your money paying for colleges and things that you couldn't afford at the time. And this is all going to come home to roost. And this is a big problem. This is not just a few people we're talking about. This is a vast, we've somehow ingrained ourselves that we have to pay for our kids' schools and we have to do these things. And they're all very, Christian moral things to do.
Yeah.
Noble. That's the word I'm looking for. Thank you. They're very noble things to do, but not at the expense of, we say we're going to do this because we love our children. But we don't think about down the road is that now I'm going to be living with my children, which is
right. The cost of
retirement.
Yeah, the cost of having to rely on them and potentially really materially, financially imposition them later in their life may be a lot higher than the cost and imposition of the kid just financing their own way through college.
Exactly. And again, look, there's with our children, they have to pay their way through school and they've got to do all this. But when they come out the other side, I've got the option. I can help them pay off student loans if I choose to. I can do a lot of things, but I'm not going to jeopardize my wife's and I retirement to pay for them through college. And I've got 4 of them to pay for. So, it ain't cheap. But these are things that we can think about as we go forward. And they're not popular. And they're very tough decisions to make. And they're not the way that we're told, the way that we're supposed to do things. But we've got to start challenging some of these views because the views are wrong. And this is why we have the retirement crisis that we're having. And we're having a retirement crisis. Don't get me wrong. The reason that so many boomers are having to work in retirement is because they can't afford to retire. We talked about healthcare last week. More and more boomers are spending all their retirement money because they didn't take care of their health on healthcare, right? They're in hospitals. They're having to, get surgeries. They're having to do all these other things, and it's just eating up all of their retirement savings.
Right. And sorry, just to underscore that, because I just saw the stats on this. It's something like $250,000 to $300,000 is sort of the average amount of out-of-pocket healthcare expenses that people have to pay from 65 on, right?
And what was that median retirement balance?
134,000.
There you go.
Exactly.
See, there's your problem, right? You got 134,000 saved up, and you're facing 250 in medical expenses. That's at today's cost, by the way, not inflation adjusted for 20 years from now.
Yeah,
so it's a very big problem.
It's a massive problem, and that's why I kind of made it the end topic here. Is because I'm guessing that most people who are watching this at least have somebody in their social circle, whether it's a family member or a close friend, that probably fits into this, aging and unprepared financially for the future bucket, because it's so huge, right?
But nobody wants to talk. Look, Adam, this is one of those taboo subjects, right? What do you not talk about over the family dinner table? Religion, politics, and money. Yeah. Right. And nobody wants to touch those, because as soon as you start talking about money, it's like, what?
Right. But to your point here, I mean, it's a kindness, right? It's a kindness to put on the table and to just work through the awkwardness around it, right?
Well, and that's it, but it's awkward, right? I'm embarrassed. I don't want to tell you what a bad job I've done for myself, or I don't want you to know how much money I have. We've developed these barriers, right? Because it's like, oh, don't ask me how much money I have. That's not polite. Don't. But these are the conversations that you need to be having, because this also ties into, you do not want a family member to die without a will. I mean, when you haven't taken just some basic proper steps for, a death in the family, the whole issue of disposing of assets and if there's money in the family, this is even a bigger problem without a will. But when the fights start over who gets what, without having that will in place, it can break up entire families.
Right. And we talked about this the last time we were talking about estate planning, and that is just such a self-inflicted wound that is so easily avoided. Right. So yes, folks, and we're going to do online. And we're going to do an estate planning webinar at some point too. We promised. But I do want to reinforce your point, because I lived through it. With this family member who was embarrassed, fearful, whatever. I totally understand all these emotions, but just did not want to confront this discussion for 15 years plus. So this was a slow motion train wreck that we could all see, but we couldn't actually take action on it because the key person at the center of it was not engaging, right? And so that put us 15 years behind the 8 ball, where when things really began hitting the road and decisions were getting forced into the picture, we just had way fewer options, because we had a decade and a half that had just been spent equivocating and avoiding and all that type of stuff, which is why I'm really underscoring, while it's awkward and emotions are going to get high and you might need to take a lot of breaks and whatnot, it's a kindness to everybody involved to get this on the table as early as possible and to begin to build that plan. Now, I did mention that there are a bunch of resources out there that are available. Again, this is where planning becomes so important, is senior housing is a big example, subsidized senior housing. So most states offer this. It all varies from state to state and whatnot. And the senior housing solutions in a state can vary widely too. Some can not be so nice, some can be nicer. But because there's so many, the demand far outstrips supply in this situation, it's only getting worse. So in the case of my relative, we found a place that she was willing to go into once she finally got on board with the plan. It took another 5 years for her to get off the list and actually be accepted into this place because demand was so high. She literally had to wait for other people to die to be able to finally have a space open up for her. But what's pretty amazing is these places, they typically, the heavily subsidized ones, they peg your rent as a percentage of your income. And in her case, and I don't think it's super uncommon, it's 30% of her Social Security check, which is not very much. So her rent is a pittance. It's magical that she's able to actually get a place that's so cheap for her to live, that has people around and support in case something happens to her and whatnot. And it is interesting. There's almost, it's not even almost, there's a lot more options that kick in if you actually have no money because you begin to qualify for all this stuff, which is great. The problem is it's different from every state and every location. So you need to have like a quarterback that understands all these state systems, who can say, okay, Lance, you qualify for these 5 different programs, and I'm going to show you how to sign up on the list, and I'm going to shepherd all through for you, because it is super arcane and super frustrating and super obscure. So, finding a good like elder care consultant, and there are folks out there, they're worth their weight in gold if you can find a good one who can be your navigator through all this stuff. But the important point is you got to start early. And you got to just fight through the awkwardness to get to the point where everybody's making decisions together.
Yeah. And I heard Saul Goodman is a good elder care guy.
Yeah, Saul Goodman. Breaking Bad, Better Call Saul. If you folks have watched that.
But yeah, but no, you're absolutely right. And there are a lot of options out there. And this is, something that we need to work on. And again, just having those conversations are very important, but again, they're very tough. But the other part about this is just also being organized. And part of these conversations is, hey, let's start getting all the paperwork together. Where's all the bank account statements? Where are all the investment account statements? And getting this stuff together, because one of the worst things that happens is somebody passes away unexpectedly, and you don't know what there is, right? Where's their insurance policy? Did they have an insurance policy? Who do you call? Which banks do they have money in or not have money in? And they can be very time consuming to chase all this stuff down and to deal with that. So part of the process is also just organization, because it can make the transition down the road from one spouse to the surviving spouse, or from the spouse or from the parent to the child, so much easier. So much easier.
Yeah. And especially, you don't want to wait until there is a surviving spouse who has no clue what her dead spouse did, right? Or all of a sudden the parent has dementia and can't be a source of answers to these questions or things like that, right? Yeah. Okay, real quick and wrapping up. A question for you, and I'm genuinely proposing it here, so I'm curious to hear your answer. But my understanding is that for a number of people who don't have so many assets that are just good for the rest of their life, no matter what happens, there are strategies that may make sense where you transition your assets to your kids or to a trust or whatnot over time, so that you individually are ultimately not having any assets or incomes that is in your name, right, even though you have supporters, and therefore you qualify for a lot more programs than you otherwise would, right? Because if you have enough assets, the system is set up right now, particularly the healthcare system, is to extract as many of those assets from you until you have no more. And then, okay, fine, we'll put you on the free list, but that's only after we've drained every dollar you have, right?
No, that runs even down. And I'm not an expert in this area. Richard Grosso and Danny Ratliff are much better adept at this, but this even goes to stuff like Medicare and Medicaid as well.
You know, they want you to kind of thinking of this a lot.
Yeah. And so, yeah, there's a lot of strategies that you'll want to think about. And again, if you've got a couple of $1 million in assets, you move on, you're fine. But if you're one of these people with 150,000 to say 300,000 in the bank, for retirement, and that's all there is, this is where you want to start thinking about strategies to where you can move some of that money, out of your name sooner rather than later, start kind of setting yourself up for, these things down the road. And again, it requires, you've got to do this properly. It can't be done at the last minute. It's these type of things. But there are strategies to do this, setting up trust, special needs trust, those type of things where you can, and again, this goes to, if you have a special, speaking of special needs, if you've got a special needs child, one of the worst things you can do for them is pass away and leave them a bunch of money, because it excludes them from being able to get government benefits until they use up that money. But you can set up a special needs trust that you can fund, and it doesn't exclude them from having access to these other government benefits. But again, this is all stuff you've got to plan. This is why having a really good estate planner or a really good financial advisor who's adept at these types of strategies can help you get this stuff set up well in advance of when you actually need it. But again, back to our conversation, it requires, the first step is having the conversation.
Yeah. Okay, so folks, so reminder, if you're interested in being alerted when we pick the date and have a registration process set up for this retirement planning webinar, just send an email to retirement@wealthion.com. We'll put you on the list. So Lance, flag for maybe next week's discussion, but I was having a back and forth with Stephanie Pomboy this morning, and I shared with her, and I think she agrees with me, but kind of my gut feel. You don't necessarily have to share this, but I feel in large, I feel the probability is not bad that the era of speculative gains is largely behind us, that it's been an easy couple of decades for people in the financial markets. You could throw a dart and pretty much the rising tide made everything go up, right? Certainly, at least in the near term, you and I think that's not going to be the case. Certainly hasn't been the case this year. We may have a year or more of this type of hard environment, but it's just bear with me for a second here. Let's assume that it is over, that we're not going to go back to the days where everything just goes up double digits year after year after year.
I don't have to work for a living?
Yeah, well, what I'm saying is, from an investing standpoint, I think income is going to become way more important than it has been. And what's so interesting is, up until the past 2 decades, that's how you invested. You invested for income. Like the vast majority of the stock market's returns came from dividend, not from share price appreciation, right? And that's, you really looked at a company's ability to produce positive cash flows and then return them to shareholders over time. And so I think we're going to be shifting back into income becoming the predominant reason why you invest. And I think it's going to become so much more important going forward for the reasons we're talking about here. We've got so many people that are so unprepared for their retirement era. Having dependable income in your later years is going to take on a huge premium, I think, compared to where it's been the past decade or two. What do you think?
I think you're right, but here's your problem. Because of what we've done to the market over the last 2 decades in particular. So again, we go back to Bill Clinton. Bill Clinton says, hey, I'm going to rein in corporate pay. So we're going to cap CEO pay at $1 million. And then Wall Street says, okay, fine, we'll just pay everybody in stock options, right? Which made this whole issue of stock buybacks and focusing more money towards increasing, doing things to increase the stock price. This has led to a dividend yield. The historically pre-2000, you hear a lot about from financial advisors. They pull out this chart and they say, well, see this chart of the stock market over the last 100 years, it's produced a 10% return. Well, 6% of that, as we said earlier in the show today, right? We said, what did we say about earnings and economic growth? They both track about 6% annually. And that's because you can't have earnings without economic growth. So if the economy's grown at 6% over the last 100 years, so has earnings, right? So where did the other 40% of the return came from? Came from dividends. The current dividend today is about 1.9, right? And so because of this shift we've done in the markets to create more of the speculative attitude, corporations are opting not to pay as much out in dividends because they would rather focus it on stock buybacks, right? I mean, Apple is a good example of this. Apple has like 150 billion in cash. They could pay a $5 dividend every year to their shareholders, but they don't. Instead, they spent $500 billion buying back shares. Now, as a shareholder, I'd be pissed, but I like the stock price because it goes up. At least it's going up for now. Eventually, this will change when stock buybacks no longer work, right? And this will be potentially this era that we're moving into. We'll see.
Right. And we pre-railed against this about 2 months ago on this program. We think they should be illegal or at least heavily.
Right. So yeah, we won't get on that one. But okay, so first of all, here's my problem. I can't buy ETFs because I'm going to get 1.9%. Can't fund a retirement on 1.9% in yield. Okay.
Right.
I'll buy bonds.
Yeah.
Right.
Which have been a disaster over the past 10 plus years, right?
But that's okay. But we're about to have one hell of a capital gain run. In fact, that may have started this past week, by the way, in longer dated bonds. But look, yields are going to go back towards zero because, as we've talked about before, with 30 trillion in debt and growing, you can't have a 5% interest rate on bonds because we can't afford the service on the debt.
Right.
The economy is all driven by debt, houses, credit cards, et cetera. So we can't have 5, 6, 7% yields on bonds because nobody can afford to buy them. We have more zombie companies running around lately than ever, and those are all dependent on low debt to stay alive. So interest rates are going to fall back towards zero. So now I can't buy bonds and generate income. So Adam, you tell me, if dividend investing is going to be important going forward and the speculative trade in the markets is over, assuming that the Fed can't come back and do QE and drop rates to zero again, then I don't know where investors are going to get returns from. It's going to have to be from fundamental value, better stock picking, that type of thing, and managing portfolios over time for creating returns that pace inflation.
So I agree with all that. It may, I appreciate you having this conversation with me because of your business model, but it may also mean some alternative assets like real estate investing or other investing in oil wells or whatever. Just things that produce a positive cash flow, right? Yeah. That you may want to be adding those into your portfolio. Specifically because you're like, that's going to be the part of my portfolio that no matter what happens to stocks, as long as oil is coming out of the ground, I'm going to get a check, every quarter.
No. Look, any good portfolio should be well diversified. And, look, I have money invested in our models that we run, but I also do hard money lending. So, I create income through hard money lending and, highly collateralized, and it takes extra work, but, that's another way to generate income. So to your point, there's always things that you should be doing. You shouldn't have all your money in stocks, right? That's and bonds. That should be part of your portfolio because they provide liquidity. The problem with real estate is it's not liquid. But I can buy multifamily apartments, I can buy houses, I can do Airbnbs, I can do a lot of things to create cash flow, and I can use a little bit of leverage to really increase that rate of return over time. So again, this should be all part of your strategy, and a good financial advisor should be able to go through there and say, okay, here's how we're going to break up these buckets. You also need to think about annuities. You need to think about whole life insurance. You need to think about, other factors of your portfolio as well to not only generate long-term tax-free or tax-deferred gains, but also protect your assets as well.
Yeah. Okay, great. All right. Well, folks, look, add to the list. If you'd like to see us do a webinar at some point in time, sort of geared around income investing, let us know in the comment section below. All right.
We're going to have an email address, income@wealthion.com.
When we get closer to it, yes. Not right now. Don't send an email to that because it's not going to go anywhere at the moment. Gotcha. All right. Well, look, folks, thanks for making it through yet another long, I think we're going to come in under an hour and a half this time, Lance, which is great for us, but just a little bit. Yeah. And folks, if this topic of retirement investing, particularly people in your life who might not be prepared for it, is hitting home in any way, and you'd like to sort of Well, let me put it this way. If you've got a story to share it in the comment section below. I know how tough it can be to deal with that. And as a community here, we can support each other. All right. Well, look, in wrapping up here, as we say every week, I just feel like the markets give us more and more reasons to underscore our basic premise here at Wealthion, which is these are hard times to invest in, folks. There's a lot of cross currents. There's a lot of challenges. The outlook ahead doesn't look super bright. So have a good plan in place and recruit the professional guidance of a great financial advisor to help be your quarterback in here. If you've got a great one already, great, stick with them. Send them this this video, ask them, hey, watch it and tell me, just explain to me how I'm well positioned for what these guys talked about. But if you don't have one, or you'd like a second opinion of one that is very close to all these topics, maybe even Lance and his firm themselves, just go to wealthion.com, fill out the quick form there and schedule a totally free, no strings attached consultation with them. They'll just listen to what your situation, they'll give you their best advice on what they think you should do. And with that, if you are enjoying these weekend long sessions with Lance and I, please do me a favor, support this channel by hitting the like button and then clicking the red subscribe button below, as well as that little bell icon right next to it. And you've got my guarantee that no matter what the markets do between now and next week, Lance and I will be here deconstructing it and trying to make the best sense we can for everybody. Lance, thanks so much for yet another great week, my friend. Everybody else, thanks so much for watching.